We're off to a good start. The room is still full. That's a good sign. The way we're going to conduct this second panel is that I will ask each panelist to make a few introductory remarks, and then we'll continue with the discussion. And please take the opportunity to pose questions. It's very important to have interaction with the audience. That's why we're here. And all our speakers are more than willing to engage with the audience. So I'll start with Robin. Robin is a close collaborator of our center and a loyal friend, someone who has spoken many times at our events in the past. And so I would urge you to listen carefully to what he has to say. He has very good knowledge of the circumstances here in Croatia, but wider in Europe and elsewhere. So Robin, please, we'll start with you. Thank you.
So, is Croatia ready for the euro? But I think a subsidiary question is, will or should Croatia ever be ready for the euro? And perhaps part of the answer is another question. Wouldn't it be a good idea to ask the Croatian people whether they thought they were ready for the euro? I was here towards the end of that referendum campaign in 2012 about joining the EU, and I can vouch for the fact, and you, I expect, can also confirm, but I can vouch for the fact that there was no discussion at that time of giving up the kuna. No discussion at all about it. It was never mentioned. And now we are told that it's a done deal. That actually when the Croats, remember only just over a third of them, voted to join the EU, they voted to accept the legislation, and the legislation does say that when you meet the particular criteria, you have to join the euro. But there was no discussion of this. Shouldn't Croatians be asked about it? Is that just a little sort of English liberal reflection that perhaps shouldn't be permitted? Well, it is permitted because really it certainly is not a democratic way of going about things. Anyway, the original arguments from back in the late 1990s for establishing European single currency really now look rather outdated, and no one, in fact, bothers to talk about them much. The euro, a single European currency, was meant, as its advocate said, to reduce, or of course between members of that Eurozone, end currency volatility. Now this was something of a red herring because it was and is perfectly possible to take action to offset the transaction costs and other uncertainties relating to that. But anyway, that was the argument. But the euro was also seen as a way to ensure easy credit, and it did. It allowed people who couldn't afford it to borrow too much, too cheaply. And the result was massive overborrowing by countries like Ireland and Greece, unsustainable asset bubbles, and then a series of crises. And these crises then finished up with, they didn't essentially cause, the 2008-2009 major international crisis. And at this point, the European Central Bank directly decided that it must stand behind the different EU zone, European zone, Eurozone members' their sovereign debt. Now this was a large difference between the view that had been taken of the ECB's functions, and it came about without any real discussion. It just happened. And what had happened really at that point was that an essentially manageable degree of currency risk had become a very difficult to manage default risk. And ever since then, the ECB has been practicing what is an unsustainable compromise. It has been interfering as best it can with different countries' fiscal decisions, while actually having control only over the monetary policy. And we can expect, without any doubt at all, we can expect that at some point in the years ahead, and probably sooner rather than later, there will be moves to take control over tax and spend and borrowing decisions from sovereign countries and centralize those too. And of course, economically, it makes sense. The question is, does it politically make sense? Does it actually politically make sense for Croats to vote at the Sabor in elections for the Sabor and then be told by the politicians there that actually they are not going to have any control over taxes that are set, or borrowing that is set, or spending that is made? I think we know the answer to that question. Other promises were made, of course, about the Eurozone, and they haven't been fulfilled either, because the Eurozone has not equaled out the disparities of income between the member states, and it has not, by and large, promoted prosperity. Now, of course, this is more difficult to judge because it's a question of what might have happened otherwise. But a reputable study by the Center for European Policy in Freiburg in 2019 examined which countries had won and lost in terms of prosperity from those 20 years of the Eurozone. And the study showed that Germany was the overwhelming winner, with the Netherlands also on the plus side. Italy, France, and Portugal were large losers. Greece had gained and then lost it all catastrophically. But generally, the trend was for a drop in prosperity. And the main reason shouldn't be a surprise to any of us who understand what one might call basic economics, and that was that there was a decline in international competitiveness. More specifically, European countries with somewhat weaker economies were no longer able to devalue their currencies. They no longer had a currency in order to make their exports cheaper and imports dearer. But let's now turn directly to Croatia, though you can see where I think this argument is leading. So let me assert quite clearly, Croatia cannot benefit any more than the less efficient southern European countries have benefited from an interest rate and monetary policy set in Brussels and determined principally by the needs of Europe's strongest economy, Germany. It cannot benefit. Productivity, or more precisely, the rate of productivity growth, determines ultimately not some series of criteria written into the legislation. Productivity growth rate determines whether a country can withstand a particular monetary and interest rate regime or not. Productivity, particularly when you are comparing productivity between different countries, is always hard to measure. But we in Croatia do know something about it, and we know something about it in practice. First of all, we who live here, I've lived here for some years now, we who live here know that this is a low productivity country. We have a big, inefficient, unreformed state sector that nobody has any serious intention of reducing or reforming in any way. There are high levels of corruption at all levels of government. There is a notoriously inefficient judicial system. And, as I know from living in central Zagreb, those responsible, mainly because of layers of bureaucracy, but Mr. Vangelich can expand on all of that, I'm sure, those responsible have not been able to make any serious repairs to central Zagreb after this great earthquake that was endured by the capital city of this country more than 2 years ago. Now, those, to my mind, are proofs of inefficiency, and they are examples of or causes of low productivity. Secondly, and this is also undoubtedly evidence that can't be contradicted, low productivity has been shown by the fact that we have low living standards here. And please remember, it is productivity. It is not government regulation of wages. It's not trade union pressure. It is productivity that determines incomes. Studies have shown, according to Eurostat, that our living standards here are about a third lower than the European average. Despite our enormous natural advantages, we are dragging along at the bottom with Bulgaria. Now, don't get me wrong, I'm not saying that this is inevitable, but it will certainly continue for a long time, and no one near the top of the state, as far as I know, has any intention of changing it. Now, Croats who leave this country and live elsewhere and work elsewhere are highly productive, so it's not inevitable, this thing, but they're not productive here. An introduction of the euro will not improve. To the contrary, it will worsen the difficulties of selling goods made in Croatia and will increase rather than decrease the exodus of manpower and talent. This also, when you come to think about it, is a spectacularly bad time to take such a far-reaching and, please note, permanent decision. Because it is an irreversible decision. There is no legislative provision for getting out of the euro once you've gone in. It is obviously set according to a political timetable. It's not my job to comment on politics, but it is set exclusively by a political timetable. We are seeing internationally a completely new world scenario, full of uncertainty. But we're already seeing inflation of 7.5% and rising. We're seeing food shortages. We're seeing hikes in energy prices. We're seeing interest rates starting to rise. As Otmar Issing has said, the European Central Bank is living in a fantasy world, the fact that it hasn't actually moved into positive interest country already, but up they will go. We don't know how far. We are seeing an enormous and dreadfully dangerous situation in Central Europe. We do not know where this war in Ukraine is going to lead to. It could lead to some kind of much wider conflict. We aren't fully out of the post-COVID situation yet. We don't know how strong and sustainable the supply lines with China that we've all been dependent on are. We are full of uncertainties. Now, the Prime Minister, Mr. Plenković, told the government, and his words were press released, on the 28th of February 2019, that's before everybody stopped talking about everything important and started talking about COVID, 28th of February 2019, he said the following. He said the euro would contribute to Croatia's long-term sustainable economic growth. And he added, we can expect also an increase in living standards, and I quote, as was the case in the countries of Central Europe, which introduced the euro, unquote. Now, I don't think this was just a slip, and I'm not trying, again, to make some political point. I have no interest except as an observer in Croatian politics. But may I just point out that most of the countries of Central Europe have not introduced the euro. They do not use the euro. What about Poland, which is the great economic success story, not just of Eastern Europe, but of the whole of Europe? Does it use the euro? No, it doesn't. And what about Hungary, another great success story? Does it use the euro? No, it doesn't. And the Czech Republic, historically and now actually the industrial center of Central Eastern Europe, does it use the euro? No, it doesn't. And these countries don't even peg their currencies to the euro, to the Eurozone via ERM2, which Croatia and Bulgaria do. And Slovakia, yes, Slovakia has the euro. Yes, it has the euro. But how does it survive with the euro? It survives, flourishes, I agree, with the euro, but it does it because it made far-reaching, radical, structural, economic reforms before that ever happened. It even introduced a very low-level flat tax. Now, nobody discusses any of those matters here. Nobody talks about economic reform as being a precondition for going into the Eurozone. People just think somehow that the Eurozone, the government thinks that it is just some sort of political decision which will look good at the end of the mandate. And I suppose ordinary people hope that some way it's actually going to mean that more money will come to Croatia. Well, I say I leave politics aside, but essentially, making a decision about your currency without making a previous decision about reforming your economy is, as we say in Britain, like putting the cart before the horse. And if you put the cart before the horse is likely to give you one hell of a kick. One hell of a kick. So I advise against it. Thank you.
Okay, we're off to a very good start. Thank you for that, Rob. And I think that introduction was very appropriate and will give us much food for thought. As we continue, I would like Mr. Vidaković, who has been quite critical of joining the Euro, to make some remarks, and then we'll continue with the panel. So, Neven, please.
Može. Ne trebam ja to, ja sam lički seljak. Like Grace Slick said at Woodstock, welcome to the morning mayhem lecture. I'm so happy someone got that. You know, I'm so happy someone got that. The kids, they don't get it. And all of my jokes are from like 60s. I almost came in and said, please allow me to introduce myself. I'm a man of wealth and taste. You get that. Wow, thank you. That's a line from a Rolling Stones song. Another great line is, peace is selling but no one's buying. That's a Megadeth album from '86. So let's see what has been selling and who bought it. It's a part of a larger lecture, but I'm going to be very brief. These are the cumulative growth rates of countries all over Europe. Now, when we were joining European Union, they said that the same people that are selling us euro, so it's basically the same, like who said talking heads? Was it?
Yes,
yeah.
yes.
Same talking heads, the dependent pro-regime government economists and the government ministers. They said that we're going to have huge economic growth. European Union will provide us with a huge economic growth. And if you look at our cumulative growth, since we joined Europe before COVID, it's 16%, okay? But if you look at, for example, here at the bottom, Albania and Bosnia and Herzegovina, they've actually had higher growth, total growth in that period. And if you look at countries that were already in Europe, which are kind of like our peers, Latvia, Lithuania, Estonia, Czechoslovakia, Bulgaria, they've all had higher growth. So European Union brought us no significant increase in economic growth. What was happening was already there. Now, my predecessor said that there's great uncertainty. I completely disagree. I know everything that is going to happen, and it's really simple. You know why it's really simple? Because I have this group of people that do stuff that tell me how it is going to happen, why, and when. Now, this group of people that you all know of and has been mystically referred to as markets. So here's the deal. What the markets are basically telling us. And these are the yields on 10-year bonds for Italy, Germany, and France. And if you see here was the bottom, and then it shot up. Now, there's a great lie of classrooms that tells you that the central banks control interest rates. That's true 99% of the times, except that one, which is the time we currently live in. So what happened here in November, European Central Bank had their meeting, and they said, and I quote, this is like my favorite quote of all times, Christine Lagarde said, we have done some serious soul searching, and there will be no inflation. Now, as you can see, I'm very well dressed in a three-piece suit. Do you know why? Because I'm a bond trader. Bond trading is a three-piece suit kind of a business. Nice and cultured. Do you know what, at that second, she told to every single bond trader in the world? We have lost control over the interest rates and over inflation. And everyone, from all my friends from Michigan who work in Hong Kong, to all my friends from Michigan who work in Kansas City and Chicago, she basically said, come rip us apart. You want to know what is going on? It's real easy. All you have to do is go on YouTube and type in shark feeding frenzy, preferably when they devour a dead whale. That's what's going on. Every single bond trader now knows that it is more profitable to collapse European financial structure than to actually support it. And how do I know that this is actually going on? Because of this huge line down here, where the interest rates in one day made a huge drop. Do you know what this was? This was a rollover in futures contracts, which means that everyone is not trading cash bonds. It's trading derivatives, which is creating a leveraged pressure on interest rates. And then, after the rollover, whoosh. And the moment she raises interest rates, all the yield curves are going to go up, and all the fiscal structure is going to become unsound. Now, here's the best part. You know how they say that European Union, you know, they talk about debt and debt to GDP ratio? Well, they say, you know, this is like the EU Euro average, and you got a below average and above average. This picture is wrong and distorted because it doesn't account for size. If you look at size, you have that top three countries, which are Germany, France, and Italy, have $8 trillion of public debt. Out of that, everyone else has only 5. And did you notice how now there's a desperate talk to remove the consensus and to create the majority vote in the European Union? And who's pushing for it? Macron. You know why? Because the sharks are closing in. And they know that if they allow all these little countries, which are financially completely insignificant, to have any vote, these 3 big countries, their debt will completely destabilize. Now, some economies like Germany might handle that, but some countries like France, no. Now, some of you will clearly say, yes, Neven, we recognize you're a very well-dressed man. You talk sense. But how do we know that everything you're telling us is true? It is because I have followed the #1 trading rule, which is not buy low, sell high. It is what is strictly forbidden in classrooms like these. God gave you eyes, pledge it to rise. So it is not me who is telling you that Europe is financially unsound. It is European Commission who is telling you that Europe is financially unsound. From the hot off the press Fiscal Sustainability Report 2001 institutional paper of European Commission. If it's red, it must be bad. So European Commission itself is saying that all these countries are basically fiscally unsound. Now, let's have a mother of all stupid ideas. If you see a burning building, what is your completely natural inclination? That is completely wrong. It is not to get out. It is obviously to run into the fire. Why is everyone laughing? That's what he said. He just told you that Croatian politicians are saying we will join Europe no matter the cost. No need for discussion. No need for critical thinking. So obviously, the idea to run away from fire is not mentally sound. And now I'm sorry that I did not use the mic because I always wanted to do that. Peace out. Mic drop. Thank you.
Thank you. Thank you, Neven. So we're, as we say in America, we're rolling. We're rolling. We've gotten off to a good start, and now we're rolling. Chris, do you want to make some remarks before we...
Yeah. Hard acts to follow. What can I do?
Thank you.
Yeah. Well, I'm not a great fan either. I was invited back in sometime in the early 2000s to speak about Spain's accession to the euro. I had more or less the same message. But the problem is, this isn't a democratic process, which in some ways is a good thing, but in other ways it's bad. The German people, citizens, were polled to see if they wanted to join the euro at the outset, and they said no, and the elite said yes. This is your fate. It's not in your control. The decisions were made. In fact, many decisions regarding the European Union are just that way. The population is asked to vote until they get the right answer. If you say no, that wasn't the right answer. You vote again. So these are some of the problems that we face here. Now, and I like the way that Robin rephrased the point here. Instead of, are you ever going to be ready for the euro, and should you be? Well, part of the problem is central banks are at the heart of the problem. Central bankers are wedded to a model that will always lead to them making the wrong decisions. That model, following Hannes's remark, came from Milton Friedman and the Chicago Monitor School, which is fixated on price inflation. And it leads them to ignore bubbles. Asset price bubbles are your fault because you want more of them and you're willing to pay a higher price. It's not that we provided the liquidity or the credit for you to do that. Central banks are completely innocent in terms of causing asset price bubbles according to their model. And this is why we are where we are now today. I disagree with the sense that central banks control interest rates. There's an illusion that they do at the moment because they're all doing the same stupid thing. That is, relentlessly keeping interest rates below human nature. Human nature is, if I lend you something, I want more back. Negative interest rates, which Christine Lagarde thinks is a wonderful thing, negative interest rates not only go against economic logic, they go against human nature. When you go against human nature, there's going to be blowback, and this is what we're going to be facing in the future. So, will you really be better off? And you will join the euro, unfortunately. So we need to know something about what is it that is so good about the euro. The European Central Bank is like every other central bank. The Bank of Japan embarked on these insane policies of zero and then now negative interest rates and endless fiscal deficits back in the early 1990s in order to restore the vitality of the Japanese economy, but it didn't happen. Going back to the early 1990s. Now, the European Central Bank, like the U.S. Federal Reserve System, the central bank of the U.S., they're following the same sort of ideas that the Bank of Japan introduced. One definition of insanity is doing the same thing over and over again, expecting different results. This is what the Japanese central bank, and all central banks have done. We need more economic activity, lower interest rates. Didn't work, they weren't low enough, lower interest rates. We need more economic activity. Let's run fiscal deficits. They weren't big enough. We need more, we need bigger. We need to borrow more. Anyway, we owe it to ourselves. We have the capacity to print money. There's no responsibility. There's no risk. There's no downside. Well, there is, and it will come back to haunt us. It turns out that there were and there are alternatives to the euro, besides the current system that you have with the central bank and so on. And I'll talk about those very briefly. Now, the idea was that the Eurozone was an optimal currency area. Well, it's not. It never was. There was a pretense. There was some discussion in the beginning. I have a bad habit of asking obnoxious questions. I was in Hong Kong when the euro was launched. Forgot now the functionary that came, and then during the presentation, I asked for a question. I said, how long before the central bank will intervene when the euro drops? That is, they set an artificial exchange rate against the dollar. I think it was 1.18, whatever. I said, when it goes below 1, when will they stop intervening? Well, everyone said, well, why do you ask these questions? We've already decided that we're going to do this, and it's a wonderful future, so we don't see problems. Anyway, politics is about imposing costs on other people and ignoring them because they don't affect you. This is what the Eurozone is about. This is what politics in general is about. It's what creating rights is about. We invent rights through political processes, and you carry the obligation, not the politician or the bureaucrat that creates that right. Others have to pay for it. So one of the things that politicians never understand are costs, because they don't bear them, especially financial costs or economic costs. There's never any evidence that the Eurozone, I mean, we saw this diversity of growth rates, and we know the culture and all these different things that across these different countries. What we've seen, the one thing that we do know, the European Monetary Union has led primarily through central bank policies of keeping interest rates far too low and far too long. And Otmar Issing, who was the first head of the European Central Bank, recently said that they're living in a fantasy world. Well, where was he 10 years ago? I mean, why did he just now discover that? Somehow he's supposed to be some brave voice. But this was shocking to me, because 10 years ago I was saying, don't do it. And here he is, a central banker, a trusted, deeply committed central banker. Now, what we see is that every country in this fiscal instability, every country, especially within the Eurozone, and all countries in Europe are affected by the interest rate policies, of course, because all central banks follow the leaders without thinking about the consequences. The soul searching? What about economic logic? My soul doesn't tell me that zero interest rates go against human nature. Economics tells me that. Now, what we found, we've got the fragility of especially Italian banks, these very large banks. We're in a dangerous situation now. And I don't know whether you're rats jumping off the lifeboat onto the Titanic, or rats jumping off the Titanic to get into a sinking lifeboat. But don't have illusions that the euro is going to be the preserver of your sort of stability for the future. Now, these failures were inevitable. I saw it in 1997 in Hong Kong. But everyone else refused to see it. They were being polite to each other. A lot of three-piece suit guys were there. A lot of guys I know that are bankers in Hong Kong. And they were just sitting there politely, not thinking through or worrying about how this single currency could go wrong. Now, at its heart, this is not an economic or financial project. It is a political project. And they have made it clear that they will do whatever they have to do to keep the euro intact. So they ran these terrible policies that violated the basic constitution behind the European Central Bank. They violated all of the stabilization promises of low interest, price inflation rates, low budget deficits as a percentage of GDP. Everybody cheated on these things. So what you're facing now, if you do join this, there's this moral hazard which Greece, in a way, was trapped. Now, it wasn't the politicians that were trapped. It's you, the citizens. They made decisions. They said, if we can borrow at low interest rates, that means we can spend more to buy political support. They did. So they expanded pensions, they lowered the retirement age, whatever they needed to do in order to get more political support. And they lied to the European Union or the European banking authorities about the condition of their fiscal affairs. And everybody knew they were lying. But the banks, the commercial banks, the private commercial banks, kept lending to Greece. Why? They knew there would be a bailout. They knew there would be a bailout, even though the European Central Bank was constitutionally unable to do that. But they ignored it. So what we found is that we had these artificially, historically low interest rates. We've never seen interest rates so low ever. Hysterically low interest rates. Below zero. There are literally tens of billions of dollars of negative nominal interest rate bonds lying around. And you know what's going to happen to the pricing of those bonds unless you're foolish enough to hold them to maturity? If you leave the bond market
yes, I do.
with the other sharks, there's only going to be sellers and no buyers. And what will happen to bond prices? They're at historic highs because interest rates are at historic lows. We get double-digit interest rates in a heartbeat. Central banks do not control interest rates. They believe they do. The market, the sharks control interest rates, and they're going to be very hungry. How many more countries are going to be like Greece? You know, your politicians will use the euro as a way of putting you into future debt, greater future debt, because it's to their advantage and to your disadvantage. They don't pay the cost. The future generations will pay. The future taxpayers will pay the cost. So, again, this is all about political goals, and they ignore economic. They promised, Draghi said, we will do whatever we have to do to keep the euro intact. So what they did in Greece, did they fix the problem in Greece? No, what they did, they gave them pieces of paper. Right, piece of paper, euro's a piece of paper. There's nothing behind it except it's legal tender where it is.
Chris, 2 minutes.
Yeah,
Two minutes.
Okay. So, but what we see is that when you trade pieces of paper, long-term bonds for short-term bonds, which was one of the solutions, changing pieces of paper. There was very little structural change, very little of the reforms that Robin referred to that are needed for long-term prosperity and increased productivity. So we had all these failed political ambitions, dishonesty. The Maastricht Accords were violated by virtually all the countries that are part of the Eurozone. The European Central Bank violated its own charter. They used bailouts, using taxpayer funds, purchased sovereign debt. They said they wouldn't do this. But they lied. Well, they didn't lie. I mean, politicians never lie. They just change their mind. Now, the problem is that central banks. Now, let's look at what you could have done. So there are alternatives. Well, you could return to a commodity standard. The people pretending that Russia is, but I doubt if they will. They don't want to give up control. But that was a possibility. You could denationalize money, have what used to be known as free banking, where people compete against government in issuing currency, a currency board. And now, like it or not, they're having to face, and in fact, they created cryptocurrencies. The disasters that we know as central banks are what created cryptocurrencies. People realized they wanted an escape. Okay, thank you very much.
Thank you, Chris. Before we open up for questions, Barbara will share a few remarks, and then we'll use the remaining time to allow you to address the panel.
Well, thank you very much, Stephen. I will keep it very, very short. One remark, Chris, Greece has made it, despite the fact that they were bailed out. They have a conservative government in place now that has undergone structural reforms for the past 2 years, and they're doing a great job. They can refinance themselves on the markets now, and they have running a surplus. So that's the good news. It can be done, but this doesn't have anything to do with the wrong policies that made before. It was a conservative government that did structural reforms. Three remarks: past, present, future. If we look at the past, and this is something also true for Croatia, despite the fact that you're a younger country, but still there is something like the European Aging Report that says who will pay the price for all that. And if you look at the big gap in 2030, 2040, 2050, it actually tells you all that it's the very few young people who will pay. One thing. Second thing, since we were talking about interest rates, R star, does everybody know what this is? The natural interest rate. The natural interest rate has to do with this pension issue, it has to do with productivity, and it has to do with consumer functions. Those things need to be taken into consideration, and R star has long gone down and is negative, and we need to look at the real price of money, and this is also trust. So keep that in mind when we're talking about that. Then the present, we've already talked about all those numbers that are in circulation. And I don't want to add on that because this is perfectly true and makes total sense. Back then, when the first bailouts were made, we were talking about 750 billion across Europe, across all institutions that were put in the basket, in all countries on the fiscal side and on the monetary side. Now, we only have one institution, that was the ECB, that put 750 billion. It was, besides IMF and many other institutions, and the European Union that put, and the nation states that put much more. So add a lot of zeros to this. And for the future, I would look into something not the facts driven, but I would remind you of solid values, European values, and about philosophy, about individualism versus collectivism, one thing. Second thing, what is truly important in these cases, about diversity. What has made Europe successful over the past hundreds of years? It was our diversity and not the one-size-fits-all. It was our different cultures, our different languages, our different backgrounds, and the ability to compete among each other or with each other for the best investors, for the best brains, for the best artists. And this created growth and well-being and productivity. And after all, we need productivity in order to compete on a global field. And it's on the one side, the United States, it's on the other side, Asia, China, but also Russia, and we are squeezed in between. So we have to help ourselves by being more competitive and by being more productive and more innovation. driven. And that's, I think, what will be the future for Croatia and all other European countries. Thank you.
Thank you. Thank you, Barbara. So the floor is open for questions. Please just briefly introduce yourself before you ask a question.
Excellent. No questions. Lunch.
Was it all just so clear? Okay, Branimir.
Either way, the research has shown that the stimulating currency brings higher exports just in the short term. In the long term, exports are determined by structural reforms and productivity of the economy. And my question is, how would that be the argument against euro and foreign national currency, something that is against the stable market?
Who's going to answer it? Should I answer it? Having your own currency gives you flexibility. It allows you to determine your own interests in particular situations. And we can't actually say that it is better to have a high currency or a low currency or a currency this or a currency that. The right value of a currency is what people are prepared to pay for that currency. The idea that we can impose particular prices on goods or services is a bad idea. It leads to distortions and it leads to all sorts of people playing the market for their own private ends rather than actually it being a source of stability. The thing is that stability and flexibility are not alternatives. What is completely true, of course, is that constantly devaluing the currency in the hope that you are therefore going to be able to avoid making economic changes is not a good idea. But what I've said is that you have to be realistic about the currency level and also that you must get on and make structural reforms. So I don't think it's either one thing or the other.
Chris?
Unfortunately, in a world of disparity in size of economies and the grotesque irresponsibility of central bankers, no good deed goes unpunished. The Swiss have more or less sound money, and they were punished for doing the right thing because people wanted to move into the Swiss franc. It drove up the value of the Swiss franc and drove down their capacity, reduced their international competitiveness. So this is one of the problems that you know, even if you want to maintain the sort of sovereignty of your monetary policy, you actually don't have it if you're a small country. You give it up to the bad agents next door, the people running the euro, in the case of the Swiss.
I would just, I would like to chime in for a split second. The whole issue on currency and exports, it has been a hot topic in Croatia, and I think it's exceptionally narrow-minded up to the point of being pointless. If you look at the old people, like the stuff that was written in Yugoslavia, which I read extensively, they always talked about monetary and credit policy, meaning the central bank produces money, fine, whatever. What happens to that money in the economy? For example, if you have fixed or flexible exchange rate, it doesn't matter what goes on as long as you have a flip side to control it. So if you have a fixed exchange rate like we do, then you have to have some kind of measures in order to prevent credit going to places you don't want to go. We have had a huge run-up in Swiss franc loans. Why? The central bank could have prevented that at any time with 10 different measures. It never happened. So it's not the issue of let's have our own currency so that we can devalue it and stimulate exports. The picture is a lot broader. We have our own currency, but we also do not want to have a high foreign debt. We do not want to have cheap imports. We do not want to have credit going to households for needless expenditures. We want to have credit go to companies to open new jobs. Why? I'm still looking for an answer to a simple question. How does it make sense on two accounts? One, that the loans to private corporations today in Croatia made by banks are smaller than 15 years ago. And you have nominal growth, real growth. How does that make sense? How does it make sense that our banks do not fund investments in the real economy? That's not an issue of a monetary policy. That's an issue of a central bank who should control and structure through regulation credit policy of banks, which is not that hard to do. But if you go about it by doing it, like they do in European Central Bank, by creating a 5,000-page document, then a point gets lost. A lot of ask the Americans will tell you that they had a perfectly simple and perfectly good banking regulation in the 60s that was on 3 pages, leverage ratio. And that's it. Banks just couldn't lend all the stuff they wanted. Then in the 80s, they removed the leverage ratio and the banks exploded. Doing what? One of the economists will tell you the fundamental problem of economy today is that savings equals loan, equals investments, has been completely violated and destroyed. So the question is, how do we structure the economy to go back to savings equals loans, which is actually not complete truth. The complete truth is savings equals deposits, deposits equals loans, loans equals investments. So you need to do that through the banking sector.
Let me add one more thing, and this comes back to the values that we discussed at the very beginning, because it's trust not only in money and in institutions, but also it's about property rights. And if we take care about our property rights and we safeguard them, then we can create an economy that is working without interventions. And yeah, I'll keep it there.
What is the solution for disinflation? Is there any solution or are we in a never-ending circle? You said that we can maybe think about going back to the commodity standard. What do you mean, gold or something? Yeah, I mean, is that realistic in the Western world?
The problem is the price inflation we see today was already baked into the cake years ago. It all started a long time ago. This was inevitable. People that follow Hayek and Mises understand this very clearly. Unfortunately, there's no solution per se, but there is a market response. And the market response is that interest rates will go up. And I'm afraid punishingly high, at least for some time. Because the reason there's this imbalance between saving and investment is that central banks have purposefully mispriced risk. There's just no cost. When you're borrowing at such low interest rates. And then the biggest borrower, of course, are governments. And it's easier for them to default. It happens quite often. And one default is price inflation. It's a form of default because they're paying you back with money that's worth less in the future. So there's no solution per se. I mean, it's impossible for central bankers to see a solution because they're trapped in a model that they can only keep going in one direction. If you don't have price inflation, you don't have problems. And so they kept going with lower interest rates. And now they're really at a loss because they don't want to raise interest rates because their model says low interest rates are good, high interest rates are bad, but they've got to go back to the natural rate. The market demands it.
One more. In the back there was a question.
Yes, one more question. I think we're running out.
I have a similar question. I also would have asked if the euro has a future in Europe, because we are always talking about this situation in the euro. And as I view it here, I think the euro will definitely not be ready for euros. Yeah, so kind of the same question, asking for a solution.
There is a solution. there is a solution to the inflation problem, which is not that complex. It's fairly trivial if you want to solve it. Here's what's going to happen. The future is exceptionally clear. It's exceptionally clear. And the possibility of this future not occurring is diminishing literally by the hour. What you will have is you will have an explosion, then an implosion. You will have that once ECB raises interest rates, you will have the bond market will go berserk. It'll become a feeding frenzy. Then you will have government deficits to go up, government debt becoming more unstable, and then that's the explosion part. And then you're going to have the implosion part, where the governments will just have to cut their budgets, and everything that happened in Greece will happen on a mass scale in Europe. Because the euro cannot explode. The possibility of someone leaving the euro or euro ceasing to exist, it's non-existent. So the only option is to basically implode, which is what happened to Greece, which is kind of like a economic depression US had in the 30s. So you will have this really high, which will last for, I didn't calculate it, but let's say 6 months to a year, and then you're going to have a really low. And in the meantime, you will have all the great stuff going on from the outside. You will have US that has made incredible fiscal consolidation. You will have China that has fiscal and monetary stimulus boosting their economy. You will have Putin cutting off gas. You will have a supply side shock. And people will just, the politicians will tell you it's for your own good, you should be incredibly happy. So the future, the way I see it, I saw this in a distance, in a really foggy way in 2019, where this stuff was starting to creep in, the commodities going up, inflation going from 0.2 to 0.4. Then the COVID basically made the initial point 10 times worse. So we're basically on the same trajectory that's been going on for the last couple of years, and the end game is literally inevitable. And this is why the economist in me says we're in real trouble. But the trader in me says this is absolutely great. I love Ursula. Ursula and Christina are like my favorite politicians. Every single time they do something, they do it stupidly, and I make money in the market. So we have these people that are profiting off of literally being vultures, and all of you, am I allowed to say screwed? No. All of you...
Try to be gentle.
Been there, done that, bought the t-shirt. And all of you basically suffering the cost and the prices. And if we have, I'm going to make a final point. I'm the youngest, so I'll be the rudest one. If all of you that, all, 5 of us and all the panelists before said is, you really left out in the cold to fend for yourself. No one's coming to rescue you. There's nothing for you out there but yourself, and literally gaining more knowledge, gaining more connections, having true values that will be recognized by other people of the same values, so you can merge and fight together. It is literally the only play you personally, and you personally, and you personally have left. It is, things have become that bad and that ugly.
Ending also on a positive note, because there is at least a theory, and it has proven true. It's the boom and bust cycles. It's what Hayek and Mises have created or invented in the last century, in the 1920s, when they analyzed the markets back then, and they predicted the boom and bust cycles. They foresaw every bubble that burst, so we can learn from that, and we can at least act or anticipate accordingly.
But may I make one remark? When Greece got into trouble, they invoked what they called austerity. You know what austerity is when you're a politician? The public sector workforce shrank by just under 10%, and the private sector workforce shrunk by 65%. Austerity means government shrinks more than the private sector. They never take that choice. They always find a way to raise taxes or to avoid the pain on them. Pensions didn't get smaller for the public sector workers. Jobs were there. They got paid.
Okay, my only regret is that the entire Croatian government isn't in the audience listening to this panel discussion. But we do have this on YouTube, so we'll make sure they watch online. Please join me in thanking the panel. So it was very stimulating. We're going to take a very short break. We have one final panel, which I urge you to stay and listen to the end. So we'll have about 10 minutes to try to stay on time, and then we'll resume at 1:05. Thank you.